Hey there, Sean from Invest to Live. I was grabbing some light bulbs this morning, or for a few places in my house where they had gone out, and I happened to walk down the cereal aisle, and I thought to myself, geez, I wonder what it would take in dividends for me to basically feed myself a year on cereal. So let's jump into that today. As always, if you don't follow or subscribe, we'd really appreciate it. We're starting to grow. We actually just hit 300, so pretty exciting day here. And if you like the video, please hit that like button. A few months ago, or maybe a couple months ago, I guess, I put up a video about how to basically get free Starbucks for life by leveraging the dividend from Starbucks stock. And that got some really good feedback, got a lot of views, one of my better videos that I've posted. So I thought, hey, maybe this would make sense from doing it from the cereal perspective as well. What I would ask, if there's any products out there, whether it's car insurance or food or a car for that matter, or a mortgage or anything, if you're curious to see what it would take to build a dividend model around that, and this is just for fun, but just give you some ideas of how to think about dividends in new ways, put a comment below and we'll pull it together and throw it out there for you to check out. But first things first, let's talk about cereal. So a few things I'm going to go over today in this video. We're going to figure out what a box of cereal is going to cost. I happen to see a box of Cheerios, so I'm going to use that as a reference. I'll show you that. We're going to take a look at a recent poll that I found online around how many boxes of cereals a standard family eats per week. Results are a little bit over there, so we'll extrapolate a little bit on that. And then also understanding what this particular stock has paid over time, the current price, the current yield, and what that dividend looks like right now. So let's jump on in. I think it's sort of a fun exercise, as always, to think about dividends in a way that's not just about the long term and the big picture. I think that's really, really important. But if you're trying to get to that early retirement, that financial independence, I think understanding the way you can pay for the pieces of your life by leveraging yield and dividends, it's a great way to think about it. And even if that's not what you're trying to do, you just want to provide yourself for a strong retirement down the road, I really think it's the same effort. You got to figure out where that money is going to come from, how you're going to apply it to your budget, and how you're going to be able to scale that ahead and leverage it for the things you need to pay for, those monthly bills that you're covering with that money you've been investing. So for those who don't know, I want to just set the baseline really quick here. A dividend is paid out typically annually, biannually, quarterly, monthly. Some dividends are paid on non-recurring time periods. These aren't as common, just so you know. So if you're investing in most U.S. stocks, and I'm saying most U.S. dividend-paying stocks, it's typically going to be either a quarterly pay or a monthly pay. And it's important to understand the difference because if you reinvest them, it helps to see how that affects the ROI of it over time by reinvesting that dividend, whether it's monthly or quarterly. We're not going to get into the weeds of that today, but just something good to be aware of. So also, a dividend is what is paid when you own a share of a stock. It can vary wildly. It can be low. Some dividends pay nothing because they're more focused on growth than returning capital. So make sure when we're looking at this and you're trying to do this for yourself that you're looking at a stock that does in fact pay a dividend if you're trying to do this exercise for fun. The other thing I want to call out as well is we're looking at today's dollars. And so here's my theory behind this. You don't have to necessarily agree, but just to make the math really simple, I'm looking at the price of this cereal in today's dollar. I'm looking at the dividend in today's dollar. I'm going to show you a bit of a history of this dividend just to show you how it's increased over time. And I think this is an important call out in thinking about dividends, that we want to make sure we're sort of following that rate of inflation where, as the price of goods go up, we want to see our dividend portfolio go up as well. So over time, this is important because as the shares of the underlying stock increase, if the dividend doesn't also increase, that yield is going to get smaller and smaller on that payout. So what we're looking for is dividends that grow over time. These aren't necessarily going to be the sexiest stocks. They're not going to be the coolest stocks. They're probably not going to be talked about a lot on social media, CNBC and Bloomberg. But these are good cores to the portfolio. And that's just where I'm coming from with this idea. I will say this as always, I am not a financial advisor. I'm not making a stock pick here for anyone. I don't know your financial situation, frankly. You should always go with the guidance of professionals who are licensed and especially insured for these kinds of things. So just treat this as a little bit of entertainment, a little bit of education, and a little bit of fun on how you can do it yourself. So look, enough talking about it. Let's jump on in. So I'm going to share my screen here. And I got some great feedback actually recently that I had one of my screens was just a little bit too small. So I think I'm going to be able to solve for that today. So let's see what we can do. So here's the first piece. I happened to walk by this family size box of Cheerios. It was selling for $3.64. So just a really good thing to be aware of. The current price for this cereal in this size, it's a 20-ounce box. It's considered the family size, is $3.64. So let's start to record this number right now. So here's my lifetime supply of Cheerios in my Excel sheet. We are going to keep this really, really basic so that you can do this with anything you want at home. It's very simple to do. So one box we can see is $3.64. So the next thing we want to understand is what does the average family eat per week, right? How many boxes per week? So we can start to extrapolate out that annual cost of what this might cost, of what this might look like for a family. And again, it's based on a little bit of fun here, a little conjecture, a little bit of feeling out what it could be, but I think it's a fun exercise either way. So all I really did here was just Google how many boxes of cereal does a family go through in a week. This seemed like a pretty good, albeit small survey, but for the sake of conversation, I thought it would make some sense. So excluding people who don't eat cereal, because they're not going to be trying to do this sort of an exercise to look at cereal, and people who are sort of average on the much larger amount of cereal per week, what I'm really seeing is the concurrence here is somewhere between 1, 2, and 3 boxes per week. So let's pick 2 boxes per week as the number we're going to work with here. And again, it varies. I don't know your personal taste or how much you eat, but just to have sort of a baseline, let's pick 2. So let's go and enter this in here, right? I'm going to say boxes per week, call it 2. And this is just how we're building out some of the math here. Now let's go back here. And the next thing I wanted to look at was, in the case of Cheerios, Cheerios is owned by General Mills. It's one of their products, one of their brands that they put out. General Mills is a common stock. It is on the NASDAQ stock exchange. It is currently trading at $61.30 per share. It's readily available. It's something practically every brokerage will have out there. So it's something that's also easy to put in your portfolio if it's of interest to you. I'm not really concerned about current price. I'm not concerned about what it has been doing lately. That's not the point of this video. This is really just about looking at the dividends. But what I really want to understand at scale was not just what it pays today, because that's important. That's important for this exercise. But as we said earlier in the video, the key here is understanding how has it paid over time. Not that the history is ever going to be that indicative of what the future will be, but just to have some sort of a general idea and feel comfortable from this exercise perspective that, that box of cereal might keep going up every year, but this dividend might follow as well. So for something like this, it's really easy to look up. All I did was go to Google and type in General Mills dividend history, and it brought me to the page here on NASDAQ with this history of dividend payments. So at a glance, here's what we can see. GIS is the symbol for General Mills. We see the ex-dividend date just passed. It has a current yield of 3.37. My opinion is that's a pretty good yield. Some people want much higher. Some people want much lower. But for me, for this exercise, this actually makes a lot of sense because it's pretty much middle range, relatively safe, no crazy numbers here. And it works for just thinking like long-term for this type of a fun exercise. We also can see that the annual dividend is just over $2 at $2.04. So that's going to be what we base some of this math off of and come up with an idea of, number one, how many shares we'll need to cover that cost of that yearly piece. And then also what's the capital expenditure to acquire shares to that dollar to match up to that dividend amount. So again, I want to point this out for a second. I am in no way suggesting that you go out and buy a boatload of shares of General Mills because this is exactly what you should do. I just think that this adds a little bit of fun, a little bit of structure to the way you think about dividends, you think about investing. And this is probably a good moment to call this out as well. There's pictures of my kids' stuff all around me when I do these videos. I actually teach them about this on a regular basis. They are younger, but they understand what a stock is. They understand what a dividend is. They understand why that's important, and they understand how to think about money. So sometimes we'll look at a box of cereal, in this case, like a Cheerios, and we start to think like, hey, is this a brand you really like? Would you want to own a piece of this company if you were thinking about investing? And we have very, very basic conversations that a child can understand. But I often think of the fact that, my goal is to not just make sure I'm educating people who like this channel, but also educating, my kids who just want to have a little bit of a basic understanding. So it's fun to make it about like something they see, right? About a product they might see in the house or something they enjoy once in a while, and explain how it works and what it means. And you can make it very fun too. Like, oh, guess what? Well, now you own a piece of Cheerios because you own General Mills shares. So lots of fun ways to do this and treat it with your family as well. So just sort of from that math perspective and getting your arms around how the markets work and what a dividend is, these are really fun and easier exercises to do at home. But let's jump back into this again here. One of the things I want to look at was how over time has this dividend been growing? So going back all the way to where the beginning of this chart is, and for the record, this is just as far as this goes. I can go further, but I didn't see a need to. We can see back in 2013, it was paying out about 38 cents per quarter. And I want to call that out. General Mills pays a quarterly dividend. There is no sign that this is stopping in the near future. I didn't see any news or indicators of that being the fact. But with all dividend payers, there's always a risk that dividend could go down, or they could stop paying altogether based on the markets, what kind of capital they have to share, also in the type of company they are. So just also things to be aware of as you're working through this. But what we can see is over time, going from 2013, we were at 38 cents per quarter, jumped up to 41, jumped up to 44, to 46, to 48, to 49, stood at 49 for a little bit, and currently today we're at 51 cents per quarter, which, as we know, works out times 4 to $2.04. So let's fire this stuff back into this dashboard, into this Excel sheet here. So annual dividend is $2.04. In the current share price, as we just saw while we're on the screen, is right at the top here, 61.30. So let's enter that as well. 61.3. So here's the basic math. Oops, sorry. Let's just make sure these numbers look good so we don't get them confused. So here's the basic math I want to think about when I go through these exercises. If we know that the average family has 2 boxes per week, we want to figure out average boxes per year. So what we're going to do is we're going to take 2 boxes, right? So we're going to do equal, click on 2, times 52 weeks a year, 104 boxes per year, theoretically. So what is going to be my number of shares I need to own, the capital to acquire them, and what kind of a dividend rate that will be? Well, first things we need to do is cost of yearly cereal. We'll expand this out just a bit here so it looks good on the screen. And hopefully this is really easy to read. I tried to make it as big as possible. So here we want to understand, well, if I'm buying 104 boxes of cereal a year, how much is it going to cost me? So what we're going to do again is we're going to create a really basic formula. We're going to equals. We're going to click here. We're going to multiply by the average box price of $3.64. And we know that we need to make $378.56 per year in dividends to cover the entire cost of cereal for the year. So I don't know if you thought this number was big or small. I'll admit when I thought about it, even though it's pretty basic math, I sort of had that moment I said, geez, you know what? That's like a pretty nice car payment worth of cereal per year. I don't know if I was expecting it to be higher or to be lower or what it was. I've never really thought about it over the course of a year. And that's why these exercises are really fun to do, both for yourself, but for anyone who wants to learn as well, because it gets you thinking about the scale and the cost of what you bring in, where you're spending your money, and how you budget as well. So let's break this down a little bit further. We know that we need to do $378.56 per year, and we know that we're going to get $2.04 per share. So what we're going to do is we're going to figure out how many shares do we need. So we are going to do equals this number, the cost of the year's cereal, divided by the annual dividend, hit enter, and I'm going to need 185 and about a half shares. So let's call it 186 to round up. So what we know is shares required equals 185.56, right, times the current share price of $61.30, and boom, we're going to need to put capital forward to buy $11,375.36 worth of General Mills shares. And by owning those shares long term, I will essentially, with that dividend, be paying for a year's supply of cereal every year. So that one-time investment, theoretically, of course, that one-time investment of $11,375.76 will cover my cereal purchases of Cheerios for a year, every year, moving forward, as long as that dividend stays in place. And we have some sort of correlation between dividend pricing and yield in that cost of cereal. So again, I'm going to ask, and I'd love to hear some comments below. When you see that 11,375, I wonder, like, does that feel like it's a lot? Does it feel unreasonable? Does it seem crazy? But then again, if you think about it, you know, what else in your life could you kind of put that capital towards from an investment perspective and wipe out an entire cost, right? This is just a fun example of something small, but I'd love to do bigger things if you're interested in seeing it. Mortgage payments, vacations, cars, maybe a low price car, maybe a high price car, whatever the case might be. Even bundling other costs, like you could look at this as both cereal and milk and understand how that flows. Now, there's even ways to take this much, much deeper. And this is how I do my research as well, is I try to start at very basic levels and then continue to add in risk factors, continue to add in other pieces of the pie. Like, to keep it simple, I want to see how the cereal prices have gone with inflation over the years. I want to look at milk. Milk is oftentimes seen as a commodity. I want to understand how those prices have ranged. What has been the risk over the years? I also might want to go further back and understand not just what General Mills has done from a dividend perspective and a yield, but also I want to understand, what about a competitor like a Kellogg's? Is Kellogg's maybe a better choice to do something like this as well? Do they have a better ranking? What are the analysts saying about these stocks? But all of that isn't the point today. I just wanted to show you guys sort of a really fun exercise to understand, how to buy cereal with your dividends to cover that cost of cereal for an entire year, essentially forever. One more exercise I want to do is let's just figure out if that 11,375 really does make sense based on that current yield. So let's go back here for 1 second and take a look at General Mills dividend history here. What I want to call out is this current yield of 3.37. So what this means is on that $11,375, if I'm getting a yield of 3.37, that should be enough to cover this. Let's just see how we check that as well in case you've never thought about this or never done it. This is sort of a fun exercise also. So let's remember 3.37 is the yield. So let's see if the yield makes sense. Oops. Yield on capital. So what we're going to do is we are going to take this, we are going to multiply that 13,37536 by, let's just double check, make sure I got my numbers right, 337. So that's 0.0337. That gets us 383.35 per year. So of course, with rounding and everything else, we are pretty much right where we need to be to cover that cost of cereal, plus a little bit extra, which is cool here too. So that's it. This is really the way I want you to start thinking about things is finance can be really complex. Finance can be really complicated and frankly, sometimes really hard to understand. But the math can be so simple that my kids can figure out how to do this on a napkin with basic numbers. We round them up to whatever, round them up, round them down, make it pretty simple. But this is how you figure things out. This is how you think about dividends, think about investing, understand yield. But the key is you do it in a way that's really, really easy, doesn't require special tools, doesn't require hours and hours of deep financial analysis. Those things are great. But just to get your feet in the water and start to understand where to put it, this is definitely a great way to do it. And it's a fun way too. So again, if there's something here that you thought was really cool, or you want to see me do it for a different type of item or service or ongoing cost in your life, I would be more than happy to do this across the board for anything. And even if there isn't necessarily a stock or company that lines up perfectly, maybe we can find some sort of a different play to cover it as well, right? Like you might have some sort of a streaming service that doesn't pay a dividend. Well, let's see if we can find another communications or similar type of situation that could cover that with a dividend too. So anyways, that's really what I have for today. I hope you had some fun here. It was really fun for me to do these kind of things. I like doing them. I absolutely am going to keep doing them with my kiddos here too. So with that, if you made it this far, and I really hope you have, please subscribe. We'd love to get some more viewers on here. Please hit that like button if you haven't already. And really, frankly, we just really appreciate you watching. Hopefully you learned something today as well. And come on back. We've got a lot more coming. Thanks so much.